Hello, family. What's up, everybody? Welcome in today's video. In today's video, what we're going to go over is Fibonacci retracements. A lot of people have been telling me to create a video explaining the Fibonacci retracements. So in this video, I'm going to talk about Fibonacci retracements, how you can use the Fibonacci retracements to actually capture over 1,000 pips in one trade. So if that sounds interesting, please do stick with us until the end. Don't forget to share with a few friends that you believe the video will be of help to them. Subscribe, turn on that bell notification so that you'll be notified whenever we release content like this in the future, as we do on a daily basis, so you don't want to miss out. Let's get it. Okay. First off, let me catch up with the charts, as my trading week ended on Wednesday. As you know that I have trading limits. So if my trading limit, as far as profits, if I hit my targets per week, I'm done for the week. If I hit my drawdown limits, I'm done for the week. So this week, fortunately, we hit our targets on Wednesday. So I was done for the week and I didn't trade for the whole week. And today I just gotten back in here. I wanted to record a YouTube video for you guys. As you know, we're family. I gotta look out for you too. So cool. Now, the Fibonacci retracement is not an indicator, as many believe. It's not an indicator per se, as people may thinking. It's not what people think. Contrary to that, it's just a tool. It is a tool that's already built in the platform. As you can see here, we have it on TradingView. Here it is, Fibonacci retracement. And it's a tool that you can actually use in your trading so that it can actually make your trading simpler, and it can actually give you, key information that can actually help your trading become easier. As the one you are using, or the one that we're going to be talking about today, is Fibonacci retracement. The two Fibonacci tools that I use is Fibonacci retracement and Fibonacci extension. But today we are only going to be talking about Fibonacci retracement. Next time we'll be talking about Fibonacci extension. So you don't want to miss that out. Turn on that bell notification and be subscribed to the channel. Now, as for the Fibonacci retracement, as the word itself says, it's Fibonacci retracement. So it always measures retracements, right? As we all understand, like in the market never moves in a straight path. The market never just, for instance, goes all the way up here. Like for instance, maybe prices were here and we wanted them to tap here. They never move in a straight line. They'll push, like this is how they'll go. They'll extend, retrace, create waves until they finally tap up here. Now, the Fibonacci retracement helps you understand, okay, if prices have moved up here, they're retracing. Where am I going to be looking for a continuation, right? Where is this retracement going to end before it continues pushing higher? That's what the Fibonacci retracement tool is used for. Understanding where prices are going to retrace to before they actually continue with the impulse move, extension, or whatever you want to call it, right? So it's a very useful tool that you can actually add on your trading arsenal that will actually help you a lot in capturing big moves, right? So obviously we can't use the price data that we have in front of us. We can, but we won't, because we don't know what's going to happen. We are going to be using price data that's already in the past. So we're going to use bar replay. I don't know, where should we go to? Okay, I think that's not far enough, so I think let's pull all the way out here. All the way out here. Replay. Yes. Okay. Let's pull all the way back here. I'm trying to capture a place where I can't even see what's going to happen next, so that okay, perhaps somewhere here. Replay, somewhere here. Somewhere out there in the far east. yeah, far east. Okay, cool. So prices are now, we can notice that. So we're going to do as if we're analyzing the market, obviously, because we want to see how it's actually used in live markets. So let's assume we don't know what's going to happen next. It's because we don't really know, because prices are very far. It's 2020 out here. during the corona pandemic. Yo, I miss those times. You are trading without the understanding of us. Yo, man, I miss those times, man. Corona pandemic did us dirty. It played us dirty. But I think it built us. You know, like Kanye West says, what doesn't kill you only makes you stronger, eh? So cool. So for instance, here we would have analyzed like that. We're like, okay, cool. This is what's happening right now. So let's see what's going to happen next. Obviously, prices are in a downtrend, so we are going to anticipate maybe prices will keep on pushing lower. Maybe once we see a breakout, we're going to look for a sell. If we see a break above here, we're going to look for a buy. Obviously, we are double biased because we haven't analyzed this pair from a higher time frame, and we're just playing the odds game right now. So let's play and see how it continues. Okay, looks like prices have broken above this structure, so this is no longer valid. Now, after prices break above that structure, we are obviously going to look for a retracement before we take a continuation, right? Right. So let's continue. Okay, so prices are retracing. Okay, now once prices are retracing, we have to apply that Fibonacci concept, right? Because it's a Fibonacci retracement tool. Now, where are we going to apply that? We're going to put that from the beginning, from the bottom here, from the tip. That's where you want to apply it. If prices are in an uptrend, you start placing the Fibonacci on the downside. If prices are in an uptrend, you start from down. If prices are in a downtrend, you start from up. So here prices are in an uptrend, so we're going to start from below here. You tap that, and then we allow it to do what it does best. And then the top, you place it on the peak. You have to make sure that the tips are covered. So here we're going to put that 618, 0.5, as these, I call them the golden key levels, and the 0.718. So these are the potential places where prices are most likely to retrace to. Now, if you want to know where exactly prices are going to retrace to, you have to incorporate that with a market structure. So for instance, on the 0.38 here, we see prices are confluencing with this structure here where prices turned around in the past. 0.5, we see prices are confluencing with this structure out here. 0.618, prices are confluencing with this. And then 0.71, prices aren't confluencing with anything here. So obviously we know that 0.718 will no longer be of value to us. So we're only going to be focusing on these three. Now, we're going to keep an eye on these three. I'm the type of trader that always takes a trade after a confirmation. That way it's less stressful and it can help with tons, right? So for instance here, we understand that prices has a potential of turning around at any of these market structures. And once it does, perhaps a continuation until our targets maybe will be aiming for these tops up here. We'll be aiming maybe for that, right? Now, we're going to wait until it presents us with a confirmation before we take a trade. So we are going to play. Oh, look at that. So this has confirmed. This is a bullish candlestick and it's a solid bullish candlestick. So this will act as our confirmation. So after that happens, and mind you guys, right now we are on the daily, but you can literally apply this on any time frame. You can take a trade as long as it gives you at least a 1:3. As you can see here, we have a 1:3.1812. So pull the trigger, we take the trade. And obviously, we are going to apply the risk management or trade management. Risk management before taking the trade and trade management after we take the trade. So we are going to risk about 97 pips, 98 pips in this. So once it reaches 98 pips here, or 100, let's put it at 100. Okay, 97.8, whatever, right here. We are going to go break even, right? Now, mind you guys, again, here we are risking 98 pips because it's the daily time frame. Never take trades on the daily time frame. Always take on the lower time frames. This is just for example purposes. So, right, 98 pips. Once it reaches here, we're going break even. So let's play and see if it's a losing trade or a winning trade. Woo! Yeah. Hold on. Okay, so prices did tap. I didn't tap on the first day. So on the following day, it did reach about 98 pips in our direction. So obviously this is a confirmation candlestick. So we took the trade. It has reached 1 hour in our direction. So we are at break even. So that means this trade that we took is now at break even, right? And it has all been supported by the 0.38 Fibonacci key level. We have taken the trade because we have seen it as bounced here. You can see here we don't have any structure. We don't have, if I'm a price action trader, so obviously the most recent structure was somewhere down here. Here, okay, we had kind of structure here. I ain't gonna lie. We had some kind of structure here. We can cover it like that. Whatever you want to cover it, however you want to cover it, right? Something like that. So it all depends on how you actually trade, right? I'm going to cover it like that because it actually confluences with this turning point back here. So I'm going to put it like that. I'll consider this kind of a false out, right? And then this was a continuation. So we actually took the trade because we saw that it bounced off around the 0.38. Now, had it not been here, it would have been really hard for us to spot this trade because we would have been waiting for prices to retrace all the way back down here to the most recent market structure, right? Now we are already at break even. So this trade right now, we are no longer risking any of our capital, right? So after that, once prices reach about 200 pips, again, this is how we manage our trades. We are going to close at least half the trade and then let the rest run. But so far, we are not having any risk in this trade. Okay. It didn't reach. Okay, it has not yet reached 2 hour, but we can see that on the daily time frame, prices are already forming a doji. Prices are forming a doji. Now, what does a doji indicate? A doji indicates that prices are losing momentum, right? Prices are losing momentum. And if prices are losing momentum, what does that mean? That means prices have a chance of retracing and going back where they came from. And we don't want that. We have already made so much money here. Why should we lose that? So we are going to make the executive decision of closing half the trade right here at about 190, about 170, 178 pips. So it will be about 1.7, 1.8 R. So if we close half the trade, we are going to close about 0.9%. 0.9% we have secured. Trade is still at break even. So let's see how it will keep on playing out. Okay. Prices just kicked in crazy and hit take profit. Insane. That's insane. I didn't expect that. Anyways, we already made money, 0.9%, and then the rest hit take profit. So at the end of the day, how much will we be making here? About 0.9 plus 0.9, obviously, because we left it running, plus the 1 hour, so it will be about 2.8. So instead of making 3 hour, we made about 2.8 hour, right? So it was based off pure price action. As you can see, we only used the Fibonacci retracement with the confluence of the market structure to get this trade, and we actually managed it according to how we would have managed it had it been on a live trade, right? And we actually managed to get about 2.8 R in this trade at a 1:3 R. So it was a beautiful trade on Euro JPY. If this video has been of help to you, please smash that like button, subscribe, turn on that bell notification. You don't want to miss out future video as we're producing them like these. It's live. We're killing it. No mercy. So thank you guys for tuning in. Thank you for watching so far. I appreciate you all. Take care, man.